Howdy, howdy, friends. Dr. E here. Let us continue with case 5. What are we really worth? And let's go on to questions 3, 4, and 5. So question 3 question 3 has to do with Dan's estimate using price ratio models, or multiples. Okay, and pros and cons. The pro is that you're using market data, and it's simple to use the multiple approach. And the cons are it can be a little too simple, and you really have to take a close look at risks and growth rates for each company that participates in the peer group. In other words, you don't want to compare a company that has, say, high leverage and slow growth with a company that has lower leverage and faster growth. Applying a multiple without doing further deeper analysis can be misleading. All right, with that in mind, let's go ahead and work through the multiples approach. So what we do is we list the multiples: PE, price to book, price to sales, price to cash flow. And this is right out of the information that's provided on page, let's see what page. This is the peer information, and it's going to be on page 57. Okay? And so these are the multiples for each of the companies, and then I've averaged them. Okay? Found the average. Okay? So these are the multiples we're going to be using. Okay? So we found the multiples. Now, Dan tells us to find the CAGR, the 4-year CAGR, for each of the fundamentals. So we go back and look on pages 50, doesn't say, page's not listed here, 54, 55, I think this is 56, and no, what is this? Well, anyway, look at the balance sheet and the income statement. And let's go ahead and look at the formula. So the formula way up here is the ending net income number divided by the beginning net income number. And so that would be 2004 divided by 2000 for net income. So that'd be $52,374,375 divided by $10,409,597 raised to the 1 over 4, or 0.25 minus 1, and we come up with our CAGR. So here's CAGR for earnings, CAGR for book value, CAGR for sales, CAGR for cash flow. Okay? Now, we're going to add 1 to each of our CAGRs and multiply. So add 1 to 0.4977, and you get 1.4977, and multiply that number by 2004's actual number. And that takes you to the estimate for 2005. So this is this number times 1 plus this number. Once again, here's the formula up here. Okay? And let's make sure we're not, there you go. Okay. B10, yes. And so we're doing that with each of the 2004 numbers multiplied times 1 plus their CAGR to get our forecast number for 2005. Okay? And that takes us down to our price. So we take our forecast earnings times our forecast multiple, okay, and then divide by 30 million, and we get our price per share using PE, price to book, price to sales, price to EBITDA. Then we divide our each of these numbers by 1 plus the cost of equity, okay, to get our price per share, present value of price per share. So here are the present values of the prices per share, average them, and we get $53.84. Okay? So once again, what are we doing? We are multiplying the forecast multiple by the forecast fundamental to get a forecast price 1 year out, and then we're finding the present value of that using the cost of equity, okay, to find our present value. And we use our CAGR of the fundamentals to forecast our fundamentals. We simply average the multiples and use the average as our forecast multiple, and then multiply our average multiple by our forecast fundamental to get our forecast price, and then divide by 30 million to get price per share, and then find the present value of the prices per share using the cost of equity 1 year out. Okay, so far, we get 53.84 there, and we've gotten $13.05 there, so there's a huge gap. Okay, now let's go to question 4, and we're going to use the dividend discount model. All right, so for the dividend discount model, we are supposed to use a multi-stage growth model, and so at the end of year 1, $1.50 is supposed to be the dividend, and then for the next 2 years it's supposed to grow 30%. So there's a D2, there is D3, and then for the next 2 years it's going to grow, not 30%, 20%. Uh-oh, a little mistake in here. So let's change that real quickly. Easily done. Change 3 to a 2. And okay, so this one's done, this one's done. That's 3. So 3, 3, 2, 2. Okay. So here are our dividends, and here is the present value of the dividends. Okay, and so we're going to divide this by we're going to divide our dividend by 1 plus the cost of equity. And this is 1 year out, this is 2 years out, 3 years out, 4 years out, 5 years out. I would ask you to look at way up to the top here in the formula line to see that we've raised it to the 1, 2, 3, 4, and 5. Okay. All right, now we have to find our terminal value. And Joe tells us to assume that the company will grow the dividend at 6% at a constant growth after year 5. Okay, so we have to find D6, and D6 equals D5, which is $3.65, times 1 plus G6, which is 6%. Okay, so $3.65 times 1.06 is D6, and then we're going to divide that by K, which is the cost of equity, minus G, which is 0.06. So the cost of equity minus 0.06. So this is D6 right up here, divided by K minus G. Okay, and we get $28.06. And let's find the present value of that that's 5 years out. So that's our D6 divided by K minus G is 2806 divided by 1 plus the cost of equity raised to the fifth, 1473. So here's the present value of each dividend, and here's the present value of the terminal value. Let us add all of these up, and we get $23.01. Now, we've got three far different numbers: $13, $53, $54, and $23. Now, I would suggest that $54 is too high, and I would suggest that $13 is too low. And one thing I would say is, knowing this author and seeing how many mistakes that he has made in the book, what he did was, in describing the cost of equity and doing using the CAPM, he said the market risk premium was 8%. And what I think he meant to say was the market expected return was 8%. So if we change our CAPM from the risk premium to the expected return of the market, then we have to subtract out minus our risk-free rate. And I think he said the risk-free rate was 4, yeah, it's right there, 4%, minus 0.04. So if we do that, if we change our CAPM calculation and say it's the risk-free rate of 4%, that's the Treasury, plus the beta, the average beta of 1.22 times the expected return of the market 8% minus the risk-free rate of 4%, then that will lower our cost of equity, okay, which will increase our value per share using the corporate value model to $30.19, which is very close to the dividend discount estimate of $38. And so let's throw out the $56. It's too high. Yeah. And all of these numbers change because the cost of equity and the CAPM change. So that goes to 56, that goes to 38, and the corporate value model goes to $30.19. So this number looks to be the outlier. We're going to throw it out, and we'll use somewhere between the corporate value model of $30 and the dividend discount model of $38. So we'll probably average that and say $34 is probably a fair price per share for the stock. So if they were to issue 30 million, let's see, 30 million shares, let's clear everything out, 30 million times $34, then they would raise $1 billion in capital, which obviously they don't need that. So they're valuing their company at $1 billion, which would be 2 times sales. Let's look at that. Sales, 500 million, 2 times 2004 sales. So price to sales, let's see, let's go up to the multiples. So price to sales, so they're valuing the company if at $1 billion, that'd be 2 times sales, and would have to go back and look to see what the margins look like. But we can see that 2 times sales is a very reasonable number. And So let's say if they wanted to, if they valued their company at $1 billion and they wanted to raise 100 million in capital, okay, then they'd only be giving away 10% of their company, and that's a reasonable thing to do in order to increase the growth rate. All right, now which leads to the question: do the forecasts assume that the company raises the money? In other words, the company is only worth $1 billion if they are able to raise the capital. Okay. All right. So we can see. I think the important things to see with regard to this case are the options that the company has. Personally, I would outsource. I take a hard look at outsourcing the manufacturing before I take it public. Taking it public, now that I know that the company's worth $1 billion and that I'll only, if I need $100 million to increase my sales and earnings, I'll only have to give away 10% of the equity. I'm okay with that. There are costs involved, there's information disclosure involved, but to take it to the very next level, I'd be willing to give up 10% of my company to raise $100 million, and the company would be worth a lot more money to me at that level than if it weren't growing. So the big question again is, how much money do they need to raise? Is it 50 million? Is it 100 million? Is it 200 million? And that's a whole nother case. That's a different different dimension to this case, and probably something that I should add to this case. I think it'd be a good thing to do, to say, hey, if this company, which is very similar to the last two cases, if this company was to grow our free cash flow in this way, how much capital would we need to raise to get there? So we're going to move on to different types of cases. If we have a chance, maybe we'll come back and add that dimension to this case. So there you have it. I'll post this spreadsheet and get after it. Peace out. Shalom.